On the line with us today is a good friend of mine, Jordan Roy-Byrne, editor of the Daily Gold newsletter. Jordan, really glad you could join us today.
Thanks for having me, Colin. It's my pleasure.
You published an article on October 4th titled Precious Metals Need Equity Market Weakness. And in the article, you noted that the HUI Gold Bugs Index is down 64%, while the S&P has rallied 43%. That is quite the divergence. Why do you think that we need to see equity market weakness in order for precious metals to rebound?
Well, there's two reasons. First of all, kind of in a micro sense, um, this has been a very long bear market in terms of price and time. When you get a correction or a bear market, those are the two ways you can measure it. Other than gold, every other subset of the precious metals sphere is down 65% in that range and has been going down for about 2.5 years. So we're near the end, but the problem is the people who invest, the gold bugs, they've lost a lot of money, so they don't have the capital or the firepower to really move this market forward, and it's going to have to come from outside and the mainstream. And the mainstream does have money because they've been investing in bonds, which have performed well until the last 6 months or year or so. And as we know, the stock market has performed fantastically over the last 4.5 years. So, and there has been that negative correlation. And so when we see the stock market start to weaken, the mainstream and fund managers, they're going to be looking for things that are not correlated to the stock market. And precious metals have not been correlated for the last 2 years. And the second reason is historically, if you look at secular bull markets in gold, you look at what's gone on in the last 12 years in the 60s and 70s, very often a cyclical top in the stock market has coincided with a cyclical bottom in gold. So those are the two reasons.
Are we reaching the top in the equity bull market in terms of the S&P and the Dow? And what data would lead you to think either that we are or we aren't yet?
Well, as far as the stock market, tops are very hard to predict because they play out in a process rather than they don't happen in an instant, where bottoms can sometimes, but not all the time, happen in an instant. There's a couple things that have been worrying me lately as far as the stock market. First of all, the fund flows, and this is kind of retail money. If you go back to 2009, 2010, the fund flows were negative. So there wasn't a lot of, you could say, dumb money or retail money moving into the market, but it's really picked up in the last year or so. And basically, fund flows have reached records basically no matter if you measure it week to week. There was a week about 2 or 3 weeks ago where the weekly fund flows hit an all-time high, and then if you measure fund flows as far as over a 9-month rolling period, that also hit an all-time high. And so the problem with that, Colin, is we're 4.5 years into a bull market. So I mean, when you get a huge amount of fund flows immediately after a major bottom, or let's say a year or even 2 years after a major bottom, it's not that much of a concern because you're still early in the shift. You're early in the new bull market. And so, but that's not where we are. We're 4.5 years into it. And so that's really a worrying sign. And even though we've had all those fund flows, the market hasn't performed that well over the last 6, 7, or 8 months. It's only, I mean, if you measure it over that period, it's flat, or maybe it's gone up a couple percent. So despite, and that's even given a huge amount of money coming into the market. So that tells us that the smart money's been selling. And on the technical side, we're just the breadth indicators are starting to look really negative. The amount of stocks that are rising or trading above certain moving averages has been falling over the last 6, 7 months, or even since the beginning of the year, depending on what you're looking at. So, I mean, I don't want to get too negative on the stock market, but I do think we're going to kind of see a mild bear market, not something on the order of 40 or 50%. I think we're going to see kind of maybe something around 30% that maybe takes 2 or 3 years to play out.
I'm going to put up one of my favorite charts that you've been compiling and posting for the past couple months, and it's titled Gold Stock Bears. I want you to take our listeners through what's going on here because there's a lot of lines on this chart. Essentially, There are 9 lines that show both the cyclical bear markets within secular bull markets, as well as secular bears preceding cyclical bull markets. Just as a reference point, the purple line that ends first on the chart is the cyclical bear market that transpired following 2008 before we had that large rebound. And the bear market we're currently in is represented by the black line on the chart. So take us through what's going on here.
Well, essentially, there's just I'll just, since there's so many lines, I just want to point out the most important points. And what we notice here is that, okay, the average bear market tends to be, we've only had one that was worse than 70%, and that was the one that came after the 1980 bubble. So predictably, that's when you get the worst bear market. As far as a cyclical bear market, the worst of it comes after a major bull market. Now, other than that, as far as how I'm measuring the bull and bear markets, we haven't seen a bear market of more than 70%. So we're in that range. We're in that range right now where we've tended to see a bottom as far as history. And looking at one thing we notice is the declines within a secular bull market, they tend to happen or terminate, I should say, much sooner than the declines when you're in a secular bear market. Because when you're in a secular bear market, the major trend is down, and therefore the cyclical bears tend to last longer. And you can see that some of those bears lasted 3.5 years or so. Whereas if you look at the major corrections within a secular bull market, those tend to last, most of them are about where we are right now. So, I mean, just to try and sum that up, as far as history, we had two major bear markets in the 1960 to 1980 bull market. And in this bull market, we've now had two major bear markets that are very similar as far as the depth of the decline. The one in 2008 was very quick. It wasn't as long as this one or the two that we had from the 60 to 80 bear market. So I guess what I'm just trying to show here is that this is normal activity for a bear market within a secular bull market.
And quickly, what are the rebounds that the gains following, in particular, the 1968 and 1974 bear markets, which look quite similar to where we're at now on the chart?
Well, I believe those bull markets, and this is the Barron's Gold Mining Index that we're looking at, and this is something that is probably more similar, or I should say most similar to the XAU. I mean, the Barron's Gold Mining Index, these are the largest mining, gold and silver mining companies. It's an index of kind of bigger, slow growth companies. So we're not talking about like the HUI here or juniors. So those two bear markets that you referenced, following those, the gains were 560% and 606%, and I believe both lasted about 4 years. So I don't know what that means for us today. I mean, history never repeats itself, but I think it's a strong indication of what's to come.
So we can expect in the juniors potentially much stronger than 500% gains.
Absolutely. I mean, there's so many, as you know, there's so many different companies, and if you're looking, I mean, if a junior producer, if it has, you know, all the things you look for, and it's going to grow its production and be around in the next 4 or 5 years, then it would perform much better than that. But at the same time, you know, some junior, there's going to be a lot of consolidation in the industry eventually. So some companies will be acquired. I mean, remember what happened with the exploration companies in 2002, 2003, and then 2009, 2010. I mean, there were so many of these companies that went up 10 or 15 times after the bottom. You really have to be diligent and careful as far as your stock picking. You can't just pick any stock and just assume it's going to go up the 5 or 10-fold. And I think it was Rick Rule who said, if you buy the sector, you'll get killed. But if you really do your due diligence and you're able to pick the winners, you can really, really make a ton of money.
One last question. When we spoke the other day, you made the point that the upcoming and final stage of this bull market in the gold equities will be reminiscent of the first leg of the bull market that occurred between 2001, I guess up until 2007. So how do you see this next move playing out, I guess, in terms of time?
Well, that's a good question, because a year or so ago, I was thinking maybe the end of this bull market was going to be 2017, 2018. But I think even at this point, I mean, the last one we had was 20 years. Right now, we're only in as far as the stocks, I think we're only in the 13th year. So I think there's a good chance that this bull market is going to play out a lot longer than we expect. And the reason why I think we're going to see that's one reason why I think we're going to see gains in a length that's similar to what we had from 2001 to 2005, or even 01 to 07. The reason is because valuations right now are super low. And that's of course what we had at the very beginning of the bull market. Valuations were super low, and then the price goes up and companies are making more money. So it's a 1-2 punch, because if you're looking at producers and companies that are making money and generating cash flow, they're valued on what's their cash flow and then what's their valuation. If their valuation doubles and their cash flow doubles, that's a 300% or a 4-fold gain. So that's why, coming out of market bottoms, especially with mining stocks, that's why you can see huge gains. It really doesn't take a lot. I mean, once things get better, the companies are obviously making more money, and at the same time, sentiment improves, and therefore valuations are going to rise at the same time. And really, if you look at this 2.5-year bear market that we've had, it's really been kind of a primary bear market, which means it's been kind of correcting the entire move that we've had for the last 10 or 11 years. And so it's set us back in many ways to a bottom that's going to be similar to the 2001 bottom. And so for those reasons, that's why I think we could see, a 5-year, maybe a 6-year drawn out bull market, instead of something that only goes up for 3 years.
Well, lots of profits lie ahead for people who are able to stick around at this point. I would ask all of our listeners to go to thedailygold.com and sign up for your newsletter. Jordan Roy-Byrne, thanks for joining us.
Thanks so much for having me.